Most viewers hear May 2026 gold delivery pressure and any persistent Shanghai over London premium and assume the story is obvious. It isn't. The paper market can say one thing while the physical market says something completely different, and that gap is where the real signal usually hides. This setup matters because LBMA has 14 days left. Why Shanghai's $112 gold premium matters now is not just a headline story. It can change the math for 112 faster than most holders expect. Stay with me, because the key signal is not the loudest one. It is the one that changes what happens next. By the end of this video, you'll know exactly which signal matters most and what it means for your next move. And I'll translate that into real stacker math with ounce-level implications, timing pressure, and acquisition cost. That is the contradiction. And here is the open loop. If the spread is this large with only about 14 days to deal with nearby delivery pressure, why cannot LBMA just smooth it out, move some bars, close the gap and move on? By the end of this video, I am going to show you why this is not just a pricing story. It is a time story, a location story, and a trust story. And those are much harder to repair than a chart. Most people hear premium and think this is just a regional markup, like one store charging more than another. That is not what matters here. A persistent Shanghai over London premium into a delivery window means buyers in the East are bidding for physical gold that actually has to be available, cleared, financed, shipped, and accepted. In the West, the reference price can still be heavily shaped by paper claims, hedging flows, and benchmark habits. In other words, the East is paying up for metal. The West is still trying to price the idea of metal. What this means for you is simple. If you are looking at a 1-ounce coin and wondering why your local dealer never seems to match the clean spot number on the screen, this is why. If a real physical premium of $112 is telling you what nearby metal is worth in a competing market, your true acquisition cost is not the headline print. On 1 ounce, that gap is annoying. On 5 ounces, it is $560. On 10 ounces, it is $1,120. That is no longer a rounding error. That is the market trying to tell you which price is honest. Now add the calendar. A weird quote on a quiet month can be ignored. A large premium moving into May 2026 delivery pressure cannot be dismissed so easily, because the closer you get to delivery, the less room there is for stories, accounting tricks, or paper reassurance. Time compresses the problem. Every day that passes turns a theoretical shortage into a practical one. It is the difference between saying gold exists somewhere in the system and proving that the right form of gold can arrive where buyers want it when they want it. This is where East versus West becomes the whole story. In the East, especially when premiums stay elevated, the market is saying physical possession matters more than benchmark loyalty. Buyers are willing to pay to pull ounces toward their side of the world. In the West, the public still gets trained to stare at spot first, as if the paper price is the final truth and every other signal is just noise. But when Shanghai pays up and London lags, the paper center is not leading. It is reacting late. What this means for you is that even if you are not buying a kilo bar in Shanghai, you are living downstream from that competition. A 1-ounce buyer feels it in dealer spreads. A 2-ounce or 5-ounce buyer feels it in timing. A 10-ounce buyer feels it in whether waiting actually saves money or just leaves you chasing a higher all-in cost later. And if you primarily stack silver, do not ignore this. Gold usually flashes the cleaner signal first when physical tightness starts outrunning paper comfort. So why can LBMA not simply fix this in 14 days? Because a premium like this is not repaired by press release. It is repaired by immediately deliverable metal in the correct place, in the correct form, at the correct time, without blowing up the confidence that the Western benchmark is already sufficient. London can have gold in the system and still have the wrong gold for the moment. A central vault can have bars that are owned, encumbered, pledged, or simply not mobile fast enough. Nearby stress does not care that the ounces exist somewhere. It cares whether they can clear now. And form matters more than people realize. The West has long revolved around large good delivery bars and a deep paper ecosystem layered on top of them. The East has been more directly anchored to physical flow, smaller units, and immediate settlement incentives. You cannot snap your fingers and turn a paper-heavy pricing complex into instant local physical relief. Bars may need to be allocated, refiners may need to convert formats, financing lines need to stay open, insurance and transport have to line up, and nobody wants to be the institution that publicly chases metal in a way that confirms the stress everybody is trying to downplay. Some people assume a $112 gap should be pure free money for arbitrage desks. Buy in the cheap market, sell in the rich market, problem solved. But that only works if the cheap ounces are unencumbered, transferable, acceptable to the receiving exchange, and worth releasing right before a nearby delivery test. Arbitrage looks instant on a spreadsheet. In a stress market, it competes with ownership rights, shipping time, refinery capacity, compliance checks, and the basic fact that holders of scarce metal become less cooperative when they sense urgency. That is why a wide premium can survive longer than people expect. What this means for you is that you should not assume smart money erases every physical distortion before retail notices. A 1-ounce buyer is not late just because a spread exists. Retail usually sees the consequence after wholesale. A 5-ounce buyer should understand that by the time dealers widen premiums, the upstream signal has already been flashing. A 10-ounce buyer should stop thinking in terms of perfect entry and start thinking in terms of access versus delay. There is another layer here that matters. One-day premium spikes can happen for technical reasons, logistics noise, even temporary enthusiasm. Persistence is the signal. If Shanghai keeps trading over London into May delivery pressure, the message is that the East is not merely paying more today, it is willing to keep paying more to secure nearby metal, while the West still relies on a benchmark that can absorb stress on paper before it admits stress in price. That is the hidden truth inside the headline. The spread is not interesting because it is exotic. It is interesting because it exposes which market has to be honest first. If this breakdown is helping you cut through the noise, hit like right here because these East versus West signals matter most before the mainstream headlines catch up. Here is the second proof point. When a premium survives into a nearby delivery month, it changes the psychology of everyone touching the chain. Holders of physical become less eager sellers. Intermediaries become more careful about promises. Importers and wholesalers start valuing certainty over theoretical cheapness, and paper markets, which normally calm everything down by expanding claims, suddenly look less persuasive because an extra claim is not an extra bar. That is when the East versus West gap stops being an academic discussion and becomes a bidding contest. What this means for you is practical. On a 1-ounce purchase, the difference between a stable market and a stress market can be the difference between a casual buy and a postponed buy. On 5 ounces, a $112 premium signal translates into the kind of cost swing people remember for years. On 10 ounces, that same signal says you are one persistent cycle away from paying over $1,000 more for the same quantity if physical stress spreads into the retail pipeline. That is why nearby delivery months matter, even if you never touch futures. At this point, if you want the next delivery pressure breakdown before May gets even tighter, subscribe because this is exactly the kind of setup that gets sanitized once the move is obvious. Now let me make this personal because this is where a lot of viewers miss the point. If you own 1 ounce of gold, this story matters because it tells you your single coin is competing in a global tug of war between physical buyers in the East and paper price management in the West. If you own 3 ounces, a $112 real-world premium implies $336 of hidden scarcity value that a screen price might not show. If you own 5 ounces, it is $560. If you own 10 ounces, it is $1,120. And if you track in kilos, 1 kilo is about 32.15 ounces. So a $112 premium implies roughly $3,600 of extra urgency embedded in physical gold. Comment with your stack size or your next target size, because the way you think about 1 ounce, 5 ounces, 10 ounces, or a kilo changes completely once you stop assuming the Western spot price is the final number. That conversation matters more right now than generic price predictions. The bigger pattern is not that the East discovered gold and the West forgot it. The bigger pattern is that the East is treating gold more like something to accumulate and secure, while the West still has powerful incentives to treat gold like something to reference, hedge, lease, and narrate. That is why the premium matters. Physical accumulation pulls ounces towards stronger hands and longer horizons. Paper suppression, or even paper lag, holds the visible price structure down longer than many people think possible. The result is a widening gap between what the benchmark says and what immediate possession costs. And this is where people get confused about paper suppression. It does not have to mean some villain in a dark room pressing a button. The simpler explanation is structural. Western paper markets can absorb fear by creating more claims, more hedges, more synthetic supply, and more reasons for traders to settle financially instead of demanding bars. That mechanism can keep the visible benchmark calmer than the physical market deserves. It is a form of suppression when it caps the urgency signal, and it is a form of lag when the cap finally breaks and spot has to catch up to what physical buyers were already paying. What this means for you is that the chart can look sleepy while the real market gets expensive. If you buy 1 ounce only a few times a year, that lag can trick you into waiting for a dip that never shows up at the counter. If you build 5 ounce or 10 ounce positions, the lag matters even more, because once the physical market forces spot higher, you lose both ways. The headline price rises and the retail premium often stays sticky. Silver stackers should care here too, even if this video is focused on gold. Gold is the cleaner reserve signal. When gold shows the East paying up for immediate metal and the West leaning harder on paper pricing, silver usually follows with more volatility, not less. That means a person building a 100-ounce silver position should watch gold delivery stress as an early warning. If gold's physical premium persists, silver's own paper-to-physical disconnect can widen quickly in the next phase. What this means for you is that a 100-ounce silver buyer should not dismiss this as somebody else's market. Gold often moves first, silver often moves harder, and the people who track only the silver spot chart can get surprised by how fast product availability and all-in cost change once the gold signal spreads across metals. So what happens next? There are really 3 paths. If the Shanghai premium narrows fast and stays narrow, then nearby pressure eased, metal flowed, and the signal cools down. If the premium narrows only briefly and then snaps back, that tells you the relief was cosmetic, probably a paper-friendly pause rather than a real fix. But if the premium stays wide or widens into May delivery, then the market is voting with urgency. At that point, the East is not just offering more money, it is challenging the West's ability to define price without surrendering more metal. Here is the practical watch list into May. Watch whether the Shanghai premium stays large on down days as well as up days. Watch whether Western commentary talks about volatility but avoids talking about physical availability. Watch whether retail dealers start blaming mint supply or temporary logistics while the screen price looks strangely calm. And watch whether any sudden narrowing in the spread lasts more than a headline cycle. Real relief persists. Cosmetic relief fades fast. What this means for you is to use the next 2 weeks like a decision window. A 1 ounce buyer can decide whether to act before the crowd notices. A 5 ounce buyer can stage entries instead of waiting for a perfect dip. A 10 ounce buyer can review cash, storage, and replacement assumptions while the market is still arguing about whether anything is wrong, and now we can close the open loop from the start. The reason LBMA cannot truly fix this in 14 days is not that London has no gold. It is that a nearby physical premium exposes the difference between having gold somewhere in a global system and having free deliverable, correctly located, immediately trusted gold that can close a spread without consequences. To fix the number quickly, London would need metal, logistics, form conversion, funding, and confidence all at once. To fix the perception, it would have to do that without revealing how dependent the Western price remains on paper elasticity. That is the part the headline misses. So when you hear that Shanghai is paying $112 over London into May delivery, do not reduce it to a curiosity. Read it as a stress test. The East is bidding for ounces. The West is still leaning on a price architecture that can absorb discomfort longer than it can absorb empty shelves. If the premium persists, the issue is not whether gold disappeared. The issue is whether the benchmark that claims to speak for gold is trailing the market that actually has to secure it. If you want the clean takeaway, here it is. One price can still be printed, but two truths can exist at once. The Eastern truth is physical metal costs more when time matters. The Western truth is paper can delay that admission, not erase it. And for a stacker, that means ounces matter more than opinions, replacement cost matters more than headline spot, and the May delivery window matters more than most people realize right now. Now the payoff is clear. Clarify what changes next, why it matters now, and how a real holder or stacker should think about the move. What this means for you is straightforward. If you hold 112, this changes how you should think about your position, your timing, and your next move. Physical stacker ounce level implications tied to East versus West pressure and real acquisition cost, that is the part most people miss, and it's the reason this setup matters beyond the headline. Subscribe if you want the next East versus West physical breakdown before this delivery story evolves, and keep your eyes on the spread, the calendar, and the real cost of actual ounces. That is where the truth shows up first.